All right, let's dive right into this explainer and unpack the absolutely explosive narrative surrounding Nebius Group, ticker symbol NBIS. Now, on the surface, this company sounds like the perfect AI infrastructure investment story, right? It's got the massive growth, it's got all the hype, and obviously it's got the soaring stock price. But you know us, we don't just buy the hype. We need to look at the raw data and the dense financial models from our sources to figure out if this is actually a generational star or just a momentum bubble waiting to pop. Quick disclaimer before we really get going. It is absolutely crucial to note that this explainer is strictly educational. We're just looking at the raw math here and conducting a case study based on public filings and source data. This is not financial advice, so please do your own homework and consult a professional before making any investment decisions. So here is our roadmap for today. First, we'll look at the AI infrastructure hype. Then we'll break down the 21 valuation models. After that, we'll cover 7 red and green flags, move into a legendary investor reality check, and finally wrap up with their moat and our final verdict. Section 1. The AI infrastructure hype. Let's see how the market's current obsession with AI infrastructure is actually playing out on the surface. Because, to understand the stock price, you really have to first understand the story being told. Just look at the sheer hypnotic velocity of their growth, 454%. Basically, Nebius Group operates as an AI cloud provider. They're renting out GPUs to companies that are training large language models. And their Q2 2026 year-over-year revenue growth hit that absolutely staggering 454% mark. When a number like that hits the headlines, honestly, it's no wonder the stock jumped hundreds of percent. It just completely captures the market's imagination. And this hypergrowth translates into real, tangible scaling. We aren't just talking about a tiny startup base here. Revenue hit $582 million. They actually flipped their adjusted EBITDA to a positive $236 million, signed 4 separate AI cloud contracts valued at over $1 billion each, and they are aggressively scaling to 5 gigawatts of contracted power by the end of 2026. The scaling is, objectively speaking, incredibly impressive. Section 2. The 21 valuation models. But as we transition away from the hype, we really have to poke some holes in the narrative and look at the actual relationship between price and intrinsic value, because as an investor, your returns are dictated by the price you pay today, not just the growth of tomorrow. This table beautifully organizes the rigorous math behind 21 different valuation models outlined in the source data. Grouping them into 5 categories helps us cover all our bases. So looking at discounted cash flow models, we get an intrinsic value of $50 to $65. Income models, like the residual income model, spit out $30 to $40. They get heavily punished there by their negative return on invested capital. Even looking at generous comparables and multiples, we land at $100 to $150. Asset-based models show $35 to $55. And finally, the absolute most aggressive, best-case scenario, real options, which factors in their massive backlog and asset-light pivot, that tops out at $180 per share. Now notice the glaring disconnect here between the $277 stock price and the fundamental estimates. The average intrinsic value sits all the way down at roughly $82.50. Even if we grant them perfect execution, literally 0 hiccups, and massive future option value at $180, the current market price is still towering over it all at nearly $280. So what this all means is that investors are currently paying a massive premium, anywhere from 150% to 400% above fundamental estimates. When you pay prices that are this disconnected from underlying cash flows, it means we are looking at pure speculation, not valuation. The market is pricing in absolute perfection for the next 5 years. Section 3. 7 red and green flags. Let's move over to the footnotes and do some investigative work to uncover the 14 financial flags the media is totally ignoring right now. Because behind that 454% growth rate, there is a very complex financial reality. Okay, there is a massive contrast here between their most terrifying risk and their strongest safety net. On the red side, Nebius has a trailing 12-month levered free cash flow of negative $9.6 billion. They are burning cash at a staggering bet-the-company kind of rate to build this infrastructure. But on the green side, customer prepayments are covering 50 to 60% of their costs. That is a massive de-risking mechanism and a powerful signal of real, somewhat desperate demand for their AI cloud services. Let's rapid fire through the rest of the severe risks. They are trading at an incredibly expensive multiple of up to 303 times EV to EBITDA. Their operating income doesn't even cover their interest expenses.
They have a negative return on invested capital of 4.10%, which essentially means they are currently destroying economic value to grow. They diluted shareholders by 22% year over year, forward GAAP earnings per share are negative, and perhaps most tellingly of all, short interest sits at nearly 29%. That means almost 1 in 3 shares is sold short by smart money that is deeply skeptical of this valuation.
But hey, to be perfectly objective, we have to look at their undeniable operational strengths too. We already talked about the 454% growth and the flip to positive adjusted EBITDA. But look at these other factors. They have $460 million in net operating loss carryforwards, providing a great future tax shield. They're pivoting to an asset-light partnership model where partners finance the data centers. They actually have a legitimate cost advantage through proprietary networking hardware, which has helped expand their gross margins to a phenomenal 70%. So the underlying business definitely has real merit. Section 4. Legendary Investor Reality Check. Let's try a fascinating thought experiment. How would the greatest investors in history view this exact same data? If we stripped away all the AI hype and just looked at the raw numbers, what would the legends actually say? We'll start with Ben Graham, the father of value investing, and of course, Warren Buffett's mentor. Graham demanded strict mathematical margins of safety before ever buying a stock. He wanted a low price-to-earnings ratio and a stock trading below its net current asset value. Well, by Graham's standards, Nebius violently shatters the rules. He wanted a PE under 15. Nebius has a trailing PE stretching from 74 all the way up to nearly 1,800, depending on the exact metric you use. If you calculate the Graham number for Nebius, it yields a valuation of roughly $14. Graham would take one look at this, call it dangerously overvalued, and pass in a heartbeat. Now, what about Peter Lynch? Unlike Graham, Lynch actually loved fast-growing companies and famously utilized the PEG ratio, price to earnings divided by growth. With Nebius growing at 454%, their PEG ratio actually looks quite attractive on paper at 0.16. But even Lynch would be deeply skeptical here. Why? Because he specifically warned against using the PEG ratio for companies growing over 50%. Using his fair value formula, a company growing at 454% should have a PE of 454. So technically, sure, the stock looks cheap, under this one specific, distorted lens. But Lynch knew that maintaining a 454% growth rate is mathematically impossible long-term. He would question the durability of that growth and ultimately walk away. Finally, let's check in with Warren Buffett, the Oracle of Omaha, and his strict focus on cash-generating moats and owner's earnings. He wants predictability, high returns on invested capital, and low debt. This data right here brutally shows that Nebius fails Buffett's tests entirely. Because of massive maintenance capex, their owner's earnings are deeply negative, highlighted right there in the middle. Their return on invested capital is a negative 4.10%, totally missing Buffett's 15% hurdle rate, and their net debt to EBITDA ratio sits dangerously high at 8.5 times. Negative earnings, capital destruction, high leverage, Buffett one touches with the 10-foot pole.
Section 5. Moat and Final Verdict. All right, let's pull all this dense data together for our final synthesis and analyze the company's actual moat to see if they can survive the coming AI infrastructure wars.
They do actually have a narrow but growing competitive advantage. It's rooted in a real cost advantage from proprietary racks and networking software, combined with high switching costs because, frankly, AI workloads are very sticky once they're deployed. They're also utilizing their asset-light partnership model to scale up efficiently. However, we have to remember that this moat is still completely unproven against massive, deep-pocketed rivals in the neocloud space, like CoreWeave. And now, this is fascinating. Look who is betting against them. Michael Burry, the legendary investor from The Big Short, is heavily betting against the stock's current momentum. He initiated a massive short position back at roughly $212 and has publicly stated it's an even bigger bet than his famous Oracle short. When the guy famous for spotting bubbles puts his money where his mouth is, it is definitely worth paying attention to. So, I leave you with this final, crucial question based on all the models we've explored today. Nebius is executing brilliantly on the ground, sure, but the stock has run hundreds of % ahead of the fundamental reality. The mathematical models from the source data are pointing one way, but the market's momentum is aggressively charging the other. Is this a generational AI winner that will magically grow into a near-perfect valuation, or is it a momentum bubble waiting for a pin? Which side are you on? Drop your intrinsic value estimate in the comments below. And hey, if you appreciate strict data-driven explainer content that cuts through the hype, be sure to hit that subscribe button to help us satisfy those YouTube guidelines we all know and love. Stay skeptical, keep learning, and I'll catch you in the next one.